Kimmel show. But let's take the conversation forward. We've got Florian Neto, CFA, Head of Investment Asia at Amundi, joining in on the show right now. Florian, hi. Great to have Unity now once again, and a 25 bips cut. But the commentary is not all that dovish, Florian. In fact, if nothing, it does talk about as to why the 25 bips had to be done because of the risks in the system. What is it that you've made of Jerome Powell's commentary?
Well, thank you for having me. Good morning. Indeed, we have a bit of diverging views within the FOMC, and the communication is not going one way. What was interesting to see is the economic projection from the Fed, and they are actually increasing growth, increasing inflation, but decreasing unemployment rate for next year and 27. So this is quite hawkish. But at the same time, when you look into the communication, it may well be the start of an easing cycle. Of course, we need the confirmation that there won't be second round effect on inflation, but it sounds more than a one-off risk management cut and done, because Chair Powell mentioned that the policy is clearly less restrictive today during the conference, so they will have a bit more to do. It's interesting to see that the Fed members show unity in spite of the diverging views we are seeing from now to the end of the year, and you see that not everybody is thinking exactly the same. But at least during this meeting, the consensus was expecting a lot of dissenter. Eventually, we have only one, Stephen Mehren. But the Fed voters have been very clear in mentioning that everything they will do going forward is conditional to the evolving inflation data, especially on the core service inflation. So, in a nutshell, it brings a bit more credibility of the Fed in this after yesterday night.
Indeed. Hi, Florian. Morning. This is Shrishti also joining in. But what's your take that how the markets will react going ahead? Because there's a risk of inflation that Fed just highlighted. Along with that, the labor market growth is seen to be slowing down. Just yesterday, there was a bit of a volatility in the U.S. markets. But going ahead, do you believe that because of tariff, because of other risks that Fed just highlighted, there could be some more pain in the store for the U.S. markets? And what's your take on emerging markets as well?
Yes, indeed. I think the key determinant of the Fed right now is the weak employment data, and Chair Powell was clear, saying this is a risk management cut. But at the same time, one cannot miss the inflation trajectory. So you have the core good inflation, and this is linked to what you mentioned about the tariff. It can come as a one-off effect. This is what has been mentioned in June and in July by the Fed. But you cannot look past the acceleration in the super core services inflation. So when you look at CPI, core CPI, super core CPI, they all came above target and rising in August. So in our view, the risk now we have is the divergence between growth and inflation. So the biggest risk is stagflation. It's not recession. So what does
We seem to have snapped that line. Just going to get back to Florian and get in his thoughts on what he is making of the Fed commentary, and especially on the mention of stagflation. But that said, our markets seem to be in ship shape. We've been holding out quite well. In fact, yesterday we made a dash to that 25,300 print. The futures as well scaled up quite nicely with 25,400 now managing to scale up. And I think Florian is back with us. Florian, can you hear us? You were making the point about how Powell did hint about stagflation as well.
Yeah, no, indeed. I was mentioning the risk on stagflation is bigger than the risk on recession. And this is what Amundi thinks as well. What is interesting to see is that, yes, labor data is weak. But apart from that, when you look into hard data, soft data, it held up quite well. When you look at the Atlanta Fed nowcast model, the GDP growth is above 3%. Retail sales earlier this week came in strong. So what does it mean for the market? It means that the economy is still strong. We have more liquidity coming. Credit condition will be a bit more easing as well. So for equity, it's a Goldilocks environment. And you may have as well a potential fiscal boost to capex going forward. So we expect a bit more volatility, but we do think that the party is still on equity, and this is our biggest conviction. Then on the bond market, it's a bit more difficult because to expect bond to price more dovishness from here is a scenario where the recession risk will have to increase in the pricing. And we do believe it makes sense to keep duration in the portfolio for carry reason, but we rather fade the rally in the US bond market. We prefer the belly, but we avoid the long end for sure. You did mention about EM assets. It's our bigger conviction. We see more upside in non-US asset. We do believe the interest rate differential with the Fed here to cut several times will push the US dollar lower. We think that growth is still quite strong. So we remain overweight in equity as our preferred asset class, and we do like EM equity. For the equity multiple to be an issue tomorrow, we need to see deterioration in credit, deterioration in liquidity condition. And this is not what we are seeing right now. So we are not selling our equity just right now.
Right, Florian, hi, morning. This is Amy also joining in. Just want to nitpick a little bit.
Right. Florian, just, to take that point forward, within the EM pool, and I know in the past we've talked about your views on India, the fact that there is easing, the government is, going about the goods and services tax rationalization as well, with now just 2 slabs, and how that's going to give a fillip to consumption. But what about valuations? Are they at comfort levels when it comes to India equities?
Well, if we dig deeper into India equity, I think you have 2 headwinds, and this is the reason why foreign investors have been selling India equity over the last 9 months. The first headwind was valuation, as you just point out, and the second one was very much earning revision, negative earning revision. So on those 2 points, I think we have improving news. One, we got a derating of India. India quarterly to date is barely positive. All the other markets in Asia are close to double-digit positive. And at the same time, we've seen moderation in the negative revision. When you look at EPS for India, they are still double-digit, and we expect 14% for this year. So we have the rating, so valuation is coming back into a more traditional band that we've seen in historical terms. The second point is the GST tax you did mention has eventually been enacted. And for us, it's a very strong move to consumption. We will see how corporate will eventually pass this through consumer. If they are passing full, it will be quite massive for consumer staple, for example. We are now monitoring very much the banks because we need the banks to perform well in India for the global markets to pull off a bit from this more range-bound type of environment that we've seen in India. But the 2 big headwinds that we were having, valuation and earnings, have been improving. That's why we are tactically overweight on India in our portfolios.
Right. Florian, hi, morning. Want to get your sense on the tariff impact that we've seen. Now we've got comments from the Fed chair saying that not the entire slowdown that we're seeing in the job market is or can largely be attributed to tariffs, but he's saying that some impact from tariff is being seen and the pass-through could be slow. What is your take on this, and how much do you think these tariffs could influence Fed policy going ahead?
Yeah, you're right. I think a part of it is coming from tariff, but at the end of the day, what we have been seeing with our analysts is basically the tariff impact has been larger on sentiment, larger on capex intention, on the guidance from a few companies, rather than on the real margin and the real earnings impact so far. So our base case is that we'll eventually land in a US tariff rate around 18%. This is above our initial estimates. So 18% is quite a drag. But when we look into the details, you see that H1 growth has been quite strong. So so far, we have not seen a big impact on growth. We downgrade moderately growth in some of the countries in the region, for example, but it's not massive. It's very, very moderate. You're right to mention that we've not seen the one-off impact on inflation and on prices yet. It will take time to feed through the whole supply chain and distribution channel, and it was very much in line with the staggered implementation of the tariff rate. So we do believe that the risk is that the temporary inflation may lead to second-round effects on inflation, And this will put the Fed in an uncomfortable position if they need to cut rate because the economy is slowing. But so far, tariff impact are expected to be temporary, and we have a razor moderate drag in growth because companies start to cut workforce to protect a bit the margin, but it's minimal so far.
So, Florian, via asset class, what are your biggest overweights right now? Because it's a unique time when equities, gold, Bitcoin, all of it is doing well.
Yeah. As I was mentioning, I think all things being equal, we still moderately risk on in our portfolio. So we are not fighting the momentum on equity, and we do believe that the recent environment is very much Goldilocks for equities, and especially for non-US equity. So this is what we have been doing. In the US, we do think there is a broadening of the markets, and some smaller and medium-sized companies can eventually benefit from the fact that the Fed will cut significantly and credit condition will improve. Then when we look into fixed income markets, we like credit. There is no reason to sell credit because the fundamental of the companies and the balance sheet are still sound, but the risk-reward ratio you have today is too small compared to what we have on equity. So if we have to choose, we did reduce a bit our high yield exposure. We did reduce a bit our investment grade exposure. If anything, we like having some duration in the portfolio, but we fade the move on the US Treasury curve. We prefer to have quality on the credits now and not chase lower in the credit spectrum. We don't want the very high beta names in the credit side that have been performing very well. We keep some gold. I was watching the TV just before, and you did mention about someone saying 25% of your portfolio should be in gold. We don't advise this such a high level of gold in this portfolio, especially with the strong runs that we've seen. But we do have gold, and we do commit to gold again because we do think that the risk on inflation is not negligible. So in general, we prefer equity. We are risk on. We fade the move on the US curve. We reduce a bit the credit, and we prefer the quality on the credit side, and we keep gold in the portfolios.
Okay, interesting. Florian, always great chatting with you. Thank you for your time.
Pleasure. Thank you.